Hundreds of ships were used by the Dutch East India Company to carry gold, porcelain, spices, and silks around the world in the 1600s. However, running such a large enterprise was not cheap. To fund their costly journeys, the company appealed to private residents, asking them to invest money in exchange for a percentage of the ship's profits. The corporation was able to afford increasingly larger journeys as a result of this approach, generating earnings for both themselves and their astute investors. The Dutch East India Company unknowingly created the world's first stock market by selling these shares in coffee houses and shipping ports across the continent. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. In today's video, we will talk about the stock market. How does it work and how do investors choose stocks? So stay tuned and watch this video till the end. This is your 3 Towers Investing channel. Today, there are schools, businesses, and even entire television channels dedicated to learning about the stock market. The modern stock market, on the other hand, is far more intricate than its predecessors. So how do today's businesses and investors use the stock market? Consider a new coffee firm that has decided to enter the market. The company will first market itself to large investors. If they think the company is a solid idea, they receive the first go at investing and then sponsor the company's initial public offering or IPO. This places the company on the formal public market where any corporation or individual who believes the company has the potential to be successful can purchase stock. The New York Stock Exchange alone trades billions of stocks every day. How do investors choose which stocks to buy with over 43,000 companies registered on stock exchanges around the world? To answer this question, it's important to first understand what stocks are and what individuals and institutions hope to achieve by investing in them. Stocks are partial shares of a company's ownership. By purchasing a stock, investors are purchasing a piece of the company's success or failure as measured by profits. The number of buyers and sellers trading a stock determines its price. If there are more buyers than sellers, the price will rise, and vice versa. The market price of a stock, and by extension, the company, shows what buyers and sellers believe the stock is worth. Purchasing stocks give investors a share of the company. Their investment aids the company growth, and as it grows more successful, other buyers may recognize the company's potential to begin purchasing stock. As demand for those stocks rises, so does their price, boosting the cost for potential buyers and increasing the value of the company's stocks already held by investors. This increased interest helps the company fund new efforts, while also increasing its total market value by demonstrating how many individuals are eager to invest in their idea. However, if a company begins to appear less profitable for some reason, the opposite can also occur. If investors believe their stock value will drop, they will sell their stocks in order to profit before the company loses even more value. The stock price, and so the company's market worth, falls as stocks are sold and demand for them falls. Unless the company begins to seem profitable again, this could result in significant losses for the investors. So the price can change dramatically based on whether investors think the company has a high potential for increasing profitability, even if it isn't profitable yet. Investors aim to gain money by buying stocks that will increase in value over time. Some investors just want to increase the value of their money quicker than inflation. Others aim to beat the market, which implies they want to grow their money faster than the overall performance of all company stocks. This idea of beating the market is a source of debate among investors. In fact, investors break into 2 main groups over it: Active investors believe that by deliberately selecting specific stocks and timing their trades, they can beat the market, while passive investors feel that it is rarely feasible to beat the market and do not subscribe to stock picking. The term beating the market usually refers to beating the Standard & Poor's 500 index on an investment. The S&P 500 is a weighted average of the performance of the 500 largest companies in the United States, weighted by company valuation, which means that companies with a higher market value have a larger impact on the S&P. Market value refers to what investors believe a company is worth rather than actual profits. Many small and mid-range stocks might vary according to diverse patterns. Thus, the S&P doesn't directly represent the market as a whole. Still, it's a solid indicator of the entire market. The stock market behaves like a voting machine in the short term and a weighing machine in the long term, which means that short-period changes in stock prices reflect public sentiment, but longer-term swings in stock prices tend to represent companies' profits. Active investors seek to profit from the market's short-term voting machine aspect. They believe the stock market is inefficient and that stock prices at any particular time may overvalue some companies, undervalue others, or fail to reflect market trends. Active investors attempt to profit from these inefficiencies by purchasing undervalued stocks. They may look into a company's operations, evaluate its financial statements, watch price movements, or employ algorithms to find inexpensive stocks. Passive investors, on the other hand, trust the market's long-term weighing machine characteristic. They believe that while markets may have inefficiencies at any given time, those inefficiencies will eventually balance out. So if they buy a portfolio of companies that represent a cross-section of the market, it will expand over time. This is usually done through index funds, which are a compilation of stocks that represent the whole market. The S&P 500 index is just one of many. All index funds have the same main goal: to hold securities for the long term while ignoring short-term market fluctuations. In the end, active and passive investing aren't mutually exclusive. Many investment methods combine the two, such as choosing stocks actively yet keeping them for the long term, as passive investing advises. Investing is far from an exact science. If there was one foolproof method, everyone would be doing it. Many factors influence the supply and demand equilibrium. Market dynamics, such as fluctuating material prices, changes in manufacturing technology, and shifting labor costs, are unavoidable impacts on businesses. Changes in leadership, negative publicity, or wider causes such as new laws and trade policies may worry investors. Of course, many investors are simply willing to sell good equities in order to achieve personal goals. All of these factors contribute to market noise, which can make organizations appear more or less successful. In the stock market, appearing to lose value frequently results in the loss of investors, and so the loss of actual value. Market confidence has the ability to cause everything from economic booms to financial disasters. And because of this difficult-to-track variable, most experts recommend long-term investing above short-term gains. Experts, on the other hand, are continuously developing ways to improve their odds of success in this very unpredictable environment. However, the stock market isn't just for the wealthy. With the advent of the internet, small investors can now purchase stocks in many of the same ways as large investors. And as more people gain knowledge of this complicated system, they will be able to trade stocks, support businesses they believe in, and achieve their financial objectives. And it all starts with getting invested. I hope you learned something from today's video. And if you do, please don't forget to hit the like button, subscribe, and click the notification bell so you won't miss out. As always, this is your 3 Towers Investing channel, giving you the latest in finance, investment, and innovation. Thanks for watching till the end, and see you in the next video.